You've probably heard the claim that Mitt Romney paid only 14% in income taxes. That number made headlines everywhere when Romney released his 2011 tax returns, and has been repeated continually by the Obama campaign and others. It's that 14% number that has led some to claim that Romney actually paid a lower tax rate than most middle-class Americans. Let's take a look at where this claim comes from and whether it's true. On Mitt and Ann Romney's 2011 tax return, it shows a total adjusted gross income of $13.7 million and a federal income tax of $1.94 million. Well, if you simply divide the tax by the gross income, that's 14.1%. So at first glance, all those headlines appear to be correct. But there are actually three problems with this calculation. The first problem is that it ignores some important deductions that reduced their taxable income, the biggest one being charitable donations. It's simply not fair to calculate someone's effective tax rate without factoring in all the money they gave to charity. Think about it. Let's say there are two taxpayers, Person 1 and Person 2. Person 1 has $1 million in income, but decides to give away $950,000 of it to charity and only keeps $50,000. Person 2 has $100,000 in income, but gives none of it away, so he keeps all $100,000. Which person will pay less income tax? Well, obviously Person 1 will pay less because his real income, the taxable income, was only $50,000. Let's say they each have to pay a tax of 10%. Person 1 will pay $5,000 and Person 2 will pay $10,000. Would you say, hey, that's unfair, Person 1 made $1 million and paid only $5,000 in taxes? Well, of course not, because he gave most of his money away to charity, and you would never count the money someone gave away to charity as part of their net income. So obviously, if you're going to compare tax rates, the only fair way to do it is to first subtract charitable donations from each person's net income. Otherwise, you could claim that Person 1's tax rate was less than 1%, when it was really 10%, just like Person 2. In 2011, the Romneys had $2.3 million in charitable donations. That's 16.4% of their income. In case you're wondering, here are just a few of the organizations they donated to. The Romneys also paid $1.2 million in job-related expenses. Well, obviously, if you make $100, but it costs you $10 to make that money, then you really only made $90. So to be fair, we have to subtract those expenses from their total income as well. Lastly, the Romneys paid another $1.5 million in state and local income taxes. If we first subtract the charitable donations and job expenses already mentioned, their real pre-tax income comes to $10.3 million. That means their state income tax rate was 15%. For comparison, the average effective state income tax for middle-income earners is about 2 to 4%. So, after subtracting their charitable donations, job-related expenses, and state and local taxes, the Romneys' real total income is reduced to $8.7 million. On that income, they paid another $1.9 million in federal taxes, which means their real federal tax rate was not 14%, but 22.1%. And their final remaining take-home income, after all taxes, was $6.8 million, less than 50% of their adjusted gross income. Many people hear that 14% number and assume it means the Romneys kept 86%, when you realize that they actually paid out over 50% in donations, job expenses, and taxes. It changes the picture. The second problem with the 14% claim is that it's misleading, because it only refers to their federal income taxes and doesn't include state taxes. As we saw a minute ago, the Romneys paid another 15% in state income taxes. If we add together their state and federal taxes, the total comes to $3.5 million. That means their total combined tax rate was not 14 or even 22%, but 34%. Many people forget about state income taxes because, for most people, the rate is much lower. But when your state and local income tax is 15%, it makes a big difference. Now, believe it or not, 34% is still not the Romneys' real tax rate, because there's a third problem. This one's a bit more complicated, but it's important because it deals with a common misunderstanding about our tax rates. Basically, it comes down to the fact that most investment income is actually taxed twice, but most people don't see the first tax. For example, $3.7 million of the Romneys' income came from dividends, including $2.2 million in qualified dividends. The federal tax rate on qualified dividends is officially 15%, but in reality it's 45%. And it can be up to 55% with state taxes. To understand why, we have to take a quick look at how business income is taxed. Let's say two people decide to form a business partnership, with each of them owning 50% of the company. If the company makes a profit during the year, the company itself doesn't pay any income tax. Instead, each partner has to pay taxes on their share of the company's profits, which they report on their own personal tax return. So, for example, if the company makes $100,000, the company itself pays no tax, but each partner reports $50,000 of income on their own personal tax return, since they each own 50%. That means the partners pay taxes on their share of the business income at their own individual tax rates, which may vary depending on their tax bracket, and they have to pay this tax regardless of whether the company actually distributes the profits to the partners or not. Either way, the IRS considers all the company profits to be the partner's own individual income. Now let's say, instead of a partnership, the company is structured as a corporation. A corporation has shareholders who each own a piece of the company, just like the partners in the previous example. Let's say this company makes $10 million. In a corporation, instead of each shareholder paying taxes on their portion of the company's profits, the company itself pays a 35% income tax, which is equal to the top individual tax rate. Essentially, the corporation is paying the income tax on behalf of its shareholders. That makes sense, since a corporation might have hundreds or thousands of shareholders, and it's not very practical to make all of them pay for their portion of the company's profits on their personal income tax returns, as they would in a partnership. In this example, the company pays $3.5 million in income tax, which is 35%, leaving the company with $6.5 million remaining. After paying its income tax, the corporation may decide to pass on some of what's left of those profits to the shareholders in the form of dividends, since it's really the shareholders' income after all. But here's the key difference when compared to a partnership. If the corporation decides to pay dividends, the shareholders have to then pay an additional 15% tax on those dividends on their personal tax returns, or up to 24% with state taxes. There's an exception for people with very low incomes, but most people have to pay that tax. It's important to understand that unlike salaries, these dividends are not tax deductible by the corporation, so the dividend tax is truly a second tax on the same income. If you receive a paycheck, your taxes are automatically deducted by your employer, so your actual take-home paycheck is less than your full salary. Imagine if you had to pay another 15 to 24% tax on your after-tax take-home pay. That's exactly what is happening with dividends. And yet, when tax rates are mentioned in our news media, they usually ignore the first tax and talk about the 15% dividend tax as if that were the full rate, especially when they're talking about taxes paid by the rich. So when you pay taxes on dividends, you are really paying 35% plus 15% of the remaining 65%, which gives you a total effective tax rate of 45%, or up to 55% with state taxes. Now it's true that very small corporations pay a lower tax rate, especially those that make less than $75,000 per year. But companies that pay dividends are almost always larger established companies, so those lower rates really would not apply. It's also true that there are some corporations in certain politically favored industries that get special tax credits and other breaks from the government, but most corporations don't get those. But to be conservative, let's assume the company only paid a 25% corporate tax, which is the historical average. Well, that still gives you an effective dividend tax of 36%, or up to 48% with state taxes. If this seems like an awfully high rate, well, it is, but it's mainly the result of that 35% corporate tax, which happens to be the highest corporate tax in the world. Both of the current presidential candidates have economic plans that will change these rates. Let's take a quick look at their proposed changes. Under the current tax code, dividends are taxed at 0% for people whose total income is under $35,000, but at 15% for everyone else. Obama's plan will keep those rates at 0% for incomes under $35,000 and at 15% for $35,000 to $200,000, but for those making over $200,000, dividends will be taxed as ordinary income. That means rates of 36 to 39.6%, depending on your income level. Romney's plan will completely eliminate the dividend tax for everyone making under $200,000, but keep the rates where they are now for those making over $200,000. Obama will also impose a 3.8% Medicare tax on investment income over $200,000, which Romney opposes. And finally, Obama will lower the corporate tax rate to 28%, and Romney will lower it to 25%. So what does that do to the effective dividend tax rate? Well, the current effective rate is 45%, which can be up to 55% with state taxes, as we've already seen. Under Obama's plan, it will increase to 59%, which can be up to 67% with state taxes. And under Romney's plan, it will decrease to 36%, which can be up to 48% with state taxes. Another example of this sort of hidden taxation is the tax on capital gains, which usually come from the sale of stocks or property. $6.8 million of Romney's income came from capital gains. Like with dividends, the official tax rate for capital gains is 15%, but in reality the effective rate is much higher because those capital gains were pre-taxed through the corporation, assuming they came from the sale of stock. The real effective tax rate on capital gains is a lot more complicated than it is for dividends. That's because many different factors can affect the price of a stock. But it should be fairly obvious that a company's profits are one of the biggest factors in determining the price of its stock. If a corporation has to pay state and federal taxes of 15 to 40%, then its profits are lowered by the same amount, which means the value of its stock will also be reduced from where it would otherwise have been if there were no corporate income tax. In other words, the capital gains a shareholder earns from selling stock have already been reduced by the corporate taxes the shareholder has already paid. Like with dividends, the 15% tax is a second tax on the same income. But capital gains can come from other sources besides corporate stock, like the sale of a house. And since there are many other variables that can affect a stock price, the real tax rate on capital gains can be anywhere from 15% to 45%, or up to 55% with state income taxes. As you can see, there are good reasons why the individual tax rate on dividends and capital gains is lower than the tax on other types of income. The biggest reason is the fact that it's a second tax. But there are other reasons as well, like the fact that low rates increase income mobility, and the fact that inflation means capital gains are actually less than they appear. For example, let's say you have an investment that gains 4% per year, and you sell it after a number of years, earning a gain of $10,000. But the average inflation during that period is also 4%. How much did you really make? Well, zero. But you still have to pay capital gains tax on the $10,000. For these and other reasons, a Republican-controlled Congress passed the Taxpayer Relief Act in 1997, which cut the capital gains rate from 28% to 20%. That's a cut of almost 30%. After initially resisting it, President Clinton finally went along with it and signed the tax cut into law. That lower rate didn't lead to greater deficits as some had predicted. Instead, the tax cut was followed by a big economic expansion in the late 90s. Even though the tax rate was lower, the government actually brought in more tax revenue than before, and we ended up with a budget surplus. While the capital gains tax cut wasn't the only factor contributing to the economic expansion, it certainly helped by encouraging investors to take on the risks of investing in new technologies. In 2003, President Bush further cut the rate from 20% to 15% where it is now. So how are the candidates planning to change the capital gains tax rate? Well, under the current tax code, the rate is 0% for those with incomes under $35,000 and 15% for everyone else, just like with dividends. Obama's plan will keep those rates at 0% for incomes under $35,000 and at 15% for $35,000 to $200,000. But for those making over $200,000, the rate will increase to 20%, and those making over $1 million would pay a minimum tax of 30%. That's even higher than the pre-Clinton rate. Romney's plan will completely eliminate capital gains tax for everyone making under $200,000, but keep the rates where they are now for those making over $200,000. Just like with dividends, Obama will impose a new 3.8% Medicare tax on incomes over $200,000, but Romney will not. And again, the corporate tax rates will decrease. So what does that do to the top effective capital gains rate? Well, as I mentioned, capital gains are complicated, so the range can be anywhere from 15 to 45%. Under Obama's plan, that range will be 34 to 52%, and under Romney's plan, the range will decrease to 15 to 36%. And once again, those top rates are even higher when you include state taxes. So getting back to the Romney's tax return, earlier we found that their effective combined state and federal tax rate was 34%, and that the remaining after-tax income was only 50% of their adjusted gross. Now that was the rate without factoring in the imputed corporate income and taxes. Imputed income is income that is pre-taxed through the corporation on dividends and capital gains. Now if we were to assume that their dividends and capital gains all came from corporations that paid the full 35% federal tax, and the average state corporate tax of 6.6%, then their real effective tax rate would come to 60%, and their take-home income would only be 33%. Well, it's probably not realistic to assume that every company paid the full tax rate. The recent average for corporations is about 25%. So let's use that for dividends. And for capital gains, let's assume that some of those gains came from things other than the sale of stock, like real estate. And let's assume some were from the sale of stock in small companies that paid less than the full corporate tax rate. So let's use a 15% total corporate rate for capital gains. That gives the Romneys a real tax rate of 48% and after-tax take-home income of only 41%. Now, just for comparison, let's assume that every company paid only a 10% total income tax. Well, that still gives the Romneys a tax rate of 42%. So when you hear someone claim that Mitt Romney paid only 14% in income tax, or even 22 or 34%, you can tell them that it was actually closer to 48%, and that doesn't even factor in the effects of inflation on capital gains. If you're wondering how those rates compare to most Americans, here's a chart showing the average effective tax rates across different income levels. Note that we've also included the state taxes and the imputed corporate taxes on investment income, so it's a fair comparison. Each of these 5 rows represents 20% of the taxpayers, from the bottom 20% to the top 20%, and the bottom 2 rows are the top 1% and top 0.1% of taxpayers. Also, note that these are the actual effective rates, not the marginal tax rates. So the combined total of state, federal, and imputed corporate taxes is here. These negative rates mean that the bottom 40% of taxpayers actually pay negative taxes. That means they get more money back from the government than they had deducted from their paychecks in the first place. So they actually make money by filing their taxes. Notice that the tax rates for the bottom 80% are much lower than the tax rate for the top 20%, and a lot lower than the tax rates for the top 1% and 0.1%. A significant portion of that is due to the fact that the imputed corporate taxes are higher for top income earners because most of their income comes from investments rather than a paycheck. Now, anyone who receives a paycheck also has to pay payroll taxes, which include things like Social Security and Medicare, and those taxes mostly affect lower income earners, as you can see. Because payroll taxes go into what is essentially a government retirement system that pays you back when you retire based on what you put in, there is a lot of debate over whether payroll taxes should really be counted as income taxes, but we've included them in the chart anyway, so you can see the totals with or without them. Note that this includes both the employer and employee payroll taxes. Even though half of the payroll taxes are paid by the employer, many economists consider both halves to be a tax on the employee. In reality, that's not completely true, but for the sake of simplicity, we'll use the full combined payroll tax. Even with the payroll taxes included, you can see that the tax rates for the top 20% and top 1% and 0.1% are still a lot higher than the rates for the bottom 80%. And that highest rate, which applies to incomes over $2 million, is right in the same range as our estimate for Mitt Romney's tax rate of 48%. So unless you make well over $2 million per year, your effective tax rate is almost certainly much lower than Mitt Romney's tax rate, no matter what anyone tells you. I'll just mention one last point about state income taxes. In most states, investment income is taxed at the same rate as ordinary income, and in many states that's a pretty high tax rate. In California, for example, the top tax bracket is 10.3%, which is the second highest in the nation. That only applies to income over $1 million, but the next bracket down is almost as high, at 9.3%, and that applies to income as low as $47,000. Those rates apply to all types of income, including investment income, which has been pre-taxed at the corporate level. The state corporate tax rate is also very high at 8.84%. So if you live in California and have primarily investment income, you're likely paying around 50% in income taxes. And then, on top of that, you get to pay the nation's highest sales tax and the nation's second highest gasoline tax. In conclusion, there are a few things to keep in mind whenever you hear someone talking about the U.S. tax system. When someone claims that the rich pay a lower tax rate than the rest of us, you can be certain they are ignoring the imputed corporate taxes on investment income. Doing this creates the illusion of lower tax rates and leads people to believe that the rich don't pay their fair share. Whenever you see a comparison of U.S. tax rates to other countries' tax rates, remember that they usually forget to include state taxes and corporate taxes. Most countries don't have separate state and federal income taxes, so it's only fair to include both taxes when making a comparison. And the US has the highest corporate tax rate in the world, so even when other countries' tax rates on investment income appear higher, the actual effective tax rate is often lower. And the last thing to remember is that the US actually has the single most progressive income tax rates of all industrialized nations, according to the OECD. In a 2008 study, they found that the US has the most progressive tax system and collects the largest share of taxes from the richest 10% of the population. And that's without including corporate taxes, which make it even more progressive. It's worth noting that President Obama's current economic plan will make it even more progressive than it currently is. Mitt Romney's plan will probably keep it about as progressive as it is now. Well, thanks for watching. Hopefully this video was informative. Look for more videos coming soon at dlas.org.